Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. This week, the UK launched its Strategic Defence Review outlining, in broad terms, a need to spend £68 billion over time to bolster the armed forces. So today on the show, we'll be looking at UK defence specialist Chemring, which was already benefiting from investors' realisation that the changing attitude of the US means more spending ahead for the UK and Europe on defence. Chris Akers is here to talk us through half-year figures. After that, we shift further afield to Latin America, whose stock markets have bounced back this year after a bad 2024. Holly McKechnie has looked at which funds are making the most of that rally. To wrap up, our company's editor, Mark Robinson, is here to discuss another stock that's doing pretty well in recent days and weeks. That's Paragon Bank. We will look at its latest figures and see what differentiates it from some of its peers. We are going to begin with Chemring, though. Chris, there's a lot to talk about here in terms of the macroeconomic context and the simple political context as well, of course. But let's start with the results themselves. How did they strike you?
Yeah, so starting with the results. So Chemring's a FTSE 250 defence specialist, as you mentioned, Dan, set out a good set of half-year results this week, which came in slightly ahead of the analyst consensus. For the 6 months to the end of April, revenue was up 5% and underlying operating profit was up 8%. Strikingly, the company disclosed a record order book of around 1.3 billion, which is up by a quarter on last year. We had order intake up by almost 70% at its countermeasures and energetics business. But on the other hand, orders fell by more than a quarter at the sensors and information arm. And that side of the business contains the R&D subsidiary Rope, which we'll come to in a bit. For the full year, management kept guidance steady. Order coverage is sitting at about 85% of expected revenue for the full year. And the shares were up strongly. So I think over 5 days, they're up by about 14 or 15%. The market likes the bullish tone the company struck on the defence review, which I think we'll come to next.
Yeah, so let's talk a bit about that review. Let's outline what some of the broad points made in said review, the kind of government's plan, and also why Chemring may be able to be one of the companies which is seeing more orders as a result of this increased spend.
Yeah, so for background, the government said this week that the UK would move into a position of what it calls war-fighting readiness as it responded to the release of this long-awaited Strategic Defence Review. It announced plans to build up to 12 new attack submarines, spend $1.5 billion on at least 6 new munitions factories, and procure up to 7,000 long-range weapons, as well as boosting investment in things like cybersecurity. In its results, Chemring pointed to significant opportunities from this review for the Roke subsidiary, and it also mentioned it's well placed to benefit from the investment in munitions and energetics and missile procurement. And I think that looks quite accurate. Roke was given a 50 million contract back in 2023 for work around Army digital systems, and the Defence Review's goal of creating what's called a new digital targeting web for the armed forces should boost work for the company in that area. There's also potential for a ramp up in air and missile defence work, given the review's mention of that area and the company's existing exposure to this work. It's got a £250 million contract in this area, which is called Storm. So things looking quite positive.
Yeah, there's two strands to the backdrop, aren't there? There's the near-term kind of retreat, or potential retreat by the US, but also this wider need, as the review puts it, to upgrade systems for a digital age, looking at a lot more advanced technology, things like that. I mean, you only have to look, I suppose, at the Ukraine drone strike in deep in Russian territory last week to show the kind of things that countries are now capable of. Ukraine, sadly, of course, is forced into this position, but there's a lot of things that could change in the UK specifically. Why don't we talk about the reaction to this and the share price reaction, given we are focused on the company itself? Some analysts thought there might not be that much of a leap on Chemring's results because the strategic review was lacking somewhat in detail in terms of timings on these things. Nonetheless, the shares did rally quite significantly. So is there a risk of disappointment in future if timings continue to be delayed, or what's the kind of path for these projects in the UK? How does the review progress to the next stage?
Yeah, so interestingly, some analysts spoke about the big share price movement this week being to do with sort of some investors moving into Chemring from more expensive European defence shares. And that could be part of the story. And there is maybe a slight concern here about, as you say, sort of uncertain timing and also sort of funding of some of the plans in the defence review. There are some more government releases coming up this year, which should provide more clarity on this. So you have the Defence Industrial Strategy plan, which is due in the next month, and that forms part of the sort of wider government industrial strategy. You also have the 10-year defence investment plan coming up. I think that's expected in the autumn. So there are releases coming up which should provide more clarity for investors in Chemring. I think something to mention here is there is some wider uncertainty about UK defence spending plans, despite the direction of travel set out in the defence review. We are a bit unclear about when the government plans to raise defence spending to 3% of GDP. It's mentioned this ambition about getting there in the next parliament, but there isn't really a particular target there. Interesting reports out in the last few days about how the UK could potentially be forced by the US and pressure from NATO Secretary General Mark Rutte to actually boost defence spending to 3.5% of GDP by 2035. But again, there's a sort of great uncertainty around that. But I think the wider direction of travel is obviously for a significant increase in spending for benefit companies like Chemring.
Yeah, indeed. Chemring as well is more UK focused than a lot of defence companies, isn't it? Almost half its revenue from the UK. There's also the context of the two different divisions. You've been talking about Roke. We should talk about that a bit more because that's part of the Sensors and Information division. And Roke specifically has been struggling a bit in recent times. So even though it could be a beneficiary of some of these spending plans when those spending plans come through, and of course we've got the wider spending review next week too, which will really, I think, underline the need to spend on all kinds of different areas of government, not just defence, and therefore highlight the pressures and perhaps the reason why there is uncertainty over when this spending is coming through. But I digress. Let's talk about Roke and some of the difficulties there. What's been happening in recent quarters with that? How are we perceiving that division in terms of future performance?
Yeah, so what we've seen at Roke is a struggle in the aftermath of the pandemic with customers moving from longer to shorter term contracts. And we've also seen orders being delayed in the lead up to the defence review. So whether that now changes is something to keep an eye on. I think longer term Roke remains a sort of essential part of the business, while the countermeasures and energetics unit is the faster growing side of Chemring. Management still wants to get Roke's revenue to more than 250 million by 2028, and that's through organic growth, and that would be almost a third of total revenue for that year based on consensus forecasts. So yeah, it's an interesting one. So while Roke has been struggling, there is still that sort of fairly bullish intention there and something for investors to keep an eye on, definitely. And it's important to note actually that the Storm contract I mentioned earlier is with Roke. So things are definitely happening despite recent struggles.
For those who don't know, we should say, well, you mentioned, Chris, that Roke was the R&D side. They develop systems for locating vehicles, tanks, mines, and also they came up with the Hawkeye system used in tennis and cricket as well. Chris, I know you're a big tennis player, so a device close to your heart, or perhaps not.
Yeah, I didn't actually know that. It's a good fact. Yeah.
Yeah. Depending on how angry you get about line calls, it'll be a help or a hindrance. Let's move on. Let's talk about acquisitions, because again, there are two sides to this story. Whether we think Chemring could be making some acquisitions, whether the company could be taken over itself, because there were suggestions that Bain were interested earlier this year that didn't really come to anything. So what's your take, Chris, on both sides of that story?
Yes, when it comes to potential for the company making further acquisitions, there's definitely potential there. There's recently been more of a focus on driving growth organically, but there was actually a bit more talk in these results about M&A. And the company mentions a live pipeline of technology and capability targets. So there is potential there. And I think the balance sheet is quite supportive of making more acquisitions. The leverage ratio sits under 1x, which is very manageable. And then on the other side of things, you had reports earlier this year about an approach for Chemring from Bain Capital, which is a US private investment firm. And reportedly, Chemring received and rejected a 1.1 billion takeover approach from Bain, and the company hasn't commented on this. But I think given the shares have risen almost 70% this year, that obviously complicates whether another approach is incoming and what sort of valuation that might be at. And I think there is also maybe a bit of politics involved here, given, as you said, Dan, Chemring takes most of its revenue from the UK. So whether the UK would want this FTSE 250 defence company being taken out by a US private firm is maybe a question to think about.
But let's wrap up by talking about the valuation. The shares have come a long way, as you said. This was, our colleagues chose it as one of the ideas of the year earlier this year. But how do we see things now? Clearly a lot of tailwinds for the business. How do we set that against the rise in the share price seen over recent months?
So the shares are now trading at about 28 times forward consensus earnings for 2025. Which actually, despite the share price gains this year, still looks cheap. So according to Investec, that valuation is still about a 40% discount to European defence peers. You have seen this re-rating, but still, looking at the broader context, still a relatively cheap option. That's one of the key reasons we remain bullish on the company.
As you say, there are potentially signs, well, there are signs, it seems, of a continued rotation, perhaps for that reason.
Yes, that's right. That's right. Something to bear in mind.
Right, now we are going to turn to Latin America, which, as I said at the top, share price-wise, stock market-wise, this year has been very good, and that has happened despite all the uncertainty we've seen elsewhere. Holly, you've looked at the region for our funds feature this week. It does come on the back of, as I said again at the top, a very bad 2024 when share prices fell by about, I think it was a fifth or a quarter even. But why don't we start by looking at the reasons for the rise this year? What kind of factors can we attribute this to other than just a bounce from the lows?
Yeah, certainly. There's been a number of factors driving those returns. Inevitably, Trump's foreign policy has had an impact. That's not to say that the tariffs have accelerated growth in the region, because they haven't. But comparatively, it's fared better than many other countries, particularly with the recent round of Liberation Day tariffs. So most Latin American countries were only subject to a 10% import duty, and Mexico managed to avoid any new tariffs as well during sort of the Liberation Day roundup. And in effect, what that's done has been to level the playing field for the region. So a big argument against Latin America has always been that there's a lot of political uncertainty there, whereas now there's basically political uncertainty everywhere. Yeah. So Latin America's sort of done a bit better out of that, even if the tariffs themselves haven't driven growth per se.
Indeed. It's unusual in a way because quite often with LATAM, certainly LATAM funds, which we'll come to in a minute, a surge in commodity prices tends to fuel big rises for the market, but that hasn't been the case this year.
Yeah, that's right. So the rally hasn't been driven by commodity prices, which is unusual for the region. And the Latin American markets have been sort of relatively unaffected actually by the declining oil prices and the metal price volatility that we've seen so far in 2025. So instead, what's been driving the rally has been financials. So funds with a sort of bigger allocation to financials have done particularly well. But yeah, it's worth bearing in mind that even though commodities aren't the driving force behind the current rally, the region does still have a big commodity dependence. So it is potentially vulnerable to sort of further volatility if more tariffs are introduced on commodities.
What about the funds that have done particularly well then this year? I mean, it is a short period of time, just under 6 months, but we'll start with that short-term performance. There's few funds out there, not a massive number, because it's not been a favoured region for certainly UK investors in recent years, which again we'll come to, but who's been doing well in the short term?
Yeah, in the short term, the sort of top three funds, you've got BlackRock Latin American Investment Trust. So that has been the top performer in the recent rally. So it's returned about 26% year to date. And its fund managers have sort of credited the favourable tariff treatment as a key factor behind the region's success. And they've also pointed towards Brazil and Mexico in particular, in terms of driving returns for the country. And those are the two sort of main players in the Latin American market. And then the Trust's open-ended sibling, the BGF Latin American Fund's also done really well. So that's returned 24% year to date. And then finally, there's the Barings Latin America Fund, which has again done very well. Again, that fund is weighted heavily towards Brazil and Mexico. And it's also got quite a big allocation to financials. So they make about a third of the portfolio's holdings. So that's been really helpful for that fund.
Some of this is interesting in the context of the fact that Brazil in particular, it's had a variety of growth concerns. I think there's going to be a drop in growth this year. There's been concerns, as there is with admittedly almost every country, about the fiscal situation, interest rates very high at the moment due to inflation, the need to combat it, and yet we are seeing this increase in the market value, or certainly as part of a wider LATAM rise. But let's talk about the long-term performance of some of these funds, because of course you need to weigh short-term performance in that context, and then so the list of the best performance changes slightly when you factor in the longer-term return.
Yeah, definitely. So when you're sort of looking at the long-term performance, the sort of investment case for LATAM funds does really weaken as performance has not been particularly strong. So while, quite a few of these funds have outperformed their benchmark in 2025, it's only the JP Morgan Latin American fund that's been able to do so consistently, both over a 3-year and 5-year period. So that's definitely something to consider if you're interested in the region.
Yeah, we do highlight some of the tracker options, or at least one option, because those, of course, are available too, and sometimes an easier way for an overseas market with which listeners may not be so familiar. We also look at a more cautious or slightly more cautious option, or some more cautious options. I mean, to me, that almost seems like an unnecessary way of looking at the region, because the whole point is for a UK investor, these are going to be higher risk, but therefore hopefully higher reward parts of your portfolio. So in order to do that, you don't have to go completely gung-ho, but equally trying to protect on the downside would maybe defeat the object. I don't know, but we do discuss a couple of funds which are a little bit more cautious.
Yeah, I think that's the thing, isn't it? You don't want to end up in a situation where you're getting the worst of both worlds and you're not getting particularly high returns, but you are putting your money at quite high risk. So is something to consider. But in terms of funds that maybe fund buyers highlight as being a bit more cautious, there's the Schroeder ISF Latin America Fund. And that's one that's been highlighted as having a sort of strong emphasis on risk management. It has done quite well this year, but in terms of where it places compared to other dedicated Latin American funds, it sort of does come in quite low. So again, it's making a call on whether that's the best way of approaching the region.
Should investors be looking at the region at all? Because one of the reasons there aren't so many funds and there hasn't been that much attention is that people would tend to focus on emerging market funds, of course, which bring in Asia as well. So there's an argument that risk budget should be placed in a broader way, which I think is a valid argument, isn't it? But it'd be interesting to see if investors get more interested in this particular region over time if performance continues.
Yeah, exactly. I think you definitely need to consider whether you do need a dedicated Latin American fund in your portfolio in the first place, because it is an inherently volatile region and quite a small market size compared to other regions. So it might make more sense for a lot of people to choose a sort of more generalist emerging market fund. And there's quite a few options out there which maybe place a bit more emphasis on Latin America than other funds. So if could be a different way into the region. So you've got the Lazard Emerging Markets Fund and M&G Global Emerging Markets. So that could be a way of accessing Latin America rather than going for a fully dedicated LATAM fund. You want really a fund manager that's taking a really active approach in that region and that can move its money between Asia and Latin America depending on what's happening in the market.
Makes sense. And that is a good point to finish, because I was aware I was almost contradicting my previous point there of saying, is there any point to a cautious fund? You want to take the full risk within that risk budget, and then on the other hand saying, but maybe you should try emerging markets for a more general approach. But you're right, the ability to move between the two if you have faith in the manager, depending on the outlook for either region, i.e. Asia Pacific and LATAM, is important. That is the funds feature this week, so have a look online. Do have a look in print as well. There's lots of details on the specific funds and the kind of allocations they have as well. We're going to wrap up, though, with Paragon Bank. Mark, you've been taking a look at the company, a landlord-focused lender, or buy-to-let focused lender, if you will. Let's talk about the figures themselves, as is traditional, to kick things off. What went right for the company?
I suppose the first point worth making is that I looked at the share price. I was taking a look at the share price after opening yesterday, once the market had time to digest the figures. And it was well received initially, after which the share price contracted a little bit, as it's done today as well. And I can only think there that there's a bit of profit taking going on, because the figures themselves were generally favourable. A number of the key ones that are in advance of consensus forecasts. The new lending, which is probably one of the more important metrics that people look at, that was 11% to the good at just under £1.4 billion. New mortgage advances as well, they were up by a quarter. That's partly, the management pointed to the effectiveness of the new digital origination system that they've got in place. That's driving business. That'll continue to do so through the remainder of the year, hopefully. The period end loan book was in line with estimates. I guess the main problem I could see from a financial perspective is that new commercial lending fell slightly during the period, although this might actually reflect some timing issues linked to the repayments of structural lending products, of which Paragon specialises in as well. Broadly favourable figures there, and the share price itself has risen steeply recently, and so if they were taking profits, it'd be at a 5-year high for the company too. So you can understand the incentive there.
There was also good news on the net interest income margin, i.e. the amount it can make from deposits in particular. And that we've seen with other banks, of course, for a couple of years now, and it's helped by the fact that interest rates aren't falling as much as people expect. Yeah. But the interesting thing with Paragon is it doesn't have this structural hedge in place that other UK banks do, which allows them to delay the impact of lower rates on their book. And yet it's still outperforming on the interest income side. So that was a pleasant surprise for shareholders, perhaps.
Yeah, I mean, as you say, most other financial institutions have these sort of mitigation policies in place, these hedges. But the reason why Paragon doesn't necessarily prioritise that might have something to do with their underwriting activities, but we'll get to that shortly. The margin itself, management are looking at an outcome for the full year of over 300 basis points. Ostensibly that's not a huge improvement over the consensus. And brokers such as Jefferies were guiding for that earlier on in the year, and that compares unfavourably to the figures last time round, which was 316. But it's certainly looking better now than it was, a few short months ago. So yeah, that's another positive.
And on the subject of cash balances, which quite often contribute to the net interest income, of course. Well, they make up a large part of it. A cash app that they're launching caught your eye.
Yeah, I spoke to management about this. It's called Spring. It's been launched, but it hasn't been operating long enough for them to make any call to how it's been received by the market. They just basically pointed out that at any one time, you've got the best part of £500 billion just sitting idly in UK current accounts. And so they're trying to work out a way they could exploit this. And I didn't go into any great detail with them about the product, but it essentially enables current account holders to utilize those funds in numerous investment products just at the flick of a switch, really. I don't know if that spreads beyond any of the products that Paragon offers itself, but I think the intellectual property is tied up in the ease of function, as far as I can understand. It's something we're going to probably have a look at in another 6 months, I think, to just see how effective that's been and whether it's driven traffic to the bank.
Yeah, it uses open banking technology, doesn't it, to try and encourage some higher rates. Well, encourage savers to take advantage of higher rates, with a little bit on the side for Paragon, of course, as well. Another thing I wanted to talk about was, with a rival to Paragon, another bank focused on landlords, OSB, that's had some issues with landlords effectively coming off the more attractive, from OSB's point of view, rate earlier, ahead of time, moving on to a lower rate, and that caused OSB some problems in particular the last couple of years. But Paragon seems to have avoided that trend. It seems to have avoided the incidents of landlords saying, "Oh, I'm a bit worried about these rates, these reversionary rates. I'm going to move quickly, avoid them." Hasn't been such a big deal for Paragon. Why might that be?
I think one of the strengths of Paragon relates to their underwriting capabilities, because I think OSB might be slightly more generalist, whereas you look at the client base for Paragon, and they offer mortgages to high net worth individuals, people that are self-employed, or even those that are buying under shared ownership schemes as well. So it tends to be bespoke, tailored to specific needs with customers with more complex circumstances, or even people that have got multiple income sources, self-employed, which would obviously in some cases have a higher risk profile, but that's reflected in their arrangements too. So it'll be more difficult for a certain proportion of their client base to move out of these products into ones that offer lower interest rates. They may not be able to at all. Everyone here knows people that are self-employed and the difficulties they have in attaining mortgage finance. Paragon's serving that part of the market, and I think the arrangements are probably less flexible, but they work to the benefit of both parties.
Yeah, it does seem that there hasn't been a big trend for them, as I say. I think some parts of OSB as well focus on its precise business. That's with a capital P is the name of the division, focuses on the smaller end of the market too, which might be seeing more activity there of people renegotiating quickly to avoid the higher rates and what have you, partly because of their own sensitivity to those higher rates. Let's wrap up by looking at the valuation. Clearly, as with many banks, Paragon has a decent dividend yield as a share buyback program that's been ongoing for a while as well. What does the overall valuation look like to you, Mark?
Well, it still remains favourable, even given the share price rise that we've seen, especially when you take into consideration their earnings growth rate compared to some of their main competitors, such as OSB. But they also compare favourably. I think their forward rating is about 9 times consensus earnings there, which is better than the peer average, although it looks a little bit lofty by comparison to OSB. But when you look at price to book, it's favourable there too. So I think, given that it's a slightly more predictable play within the market, I still think it's worth buying. And as you say, there's a decent forward dividend yield into the bargain. I suppose the outlook for all of these companies will change slightly depending on the pace at which the MPC decides to bring down interest rates over the next few months, but that's in the lap of the gods. But for the moment, I think Paragon deserves its rating that we've given it.
Well, that brings us to the end of the show. We have run out of time, so thank you very much, Mark. Thank you to you, Holly. Thank you to Chris as well, and to our producer, Vic Thornton. We'll be back next week with another Companies and Markets show.